Gold trading is a popular investment strategy in the Forex and commodities markets. Gold, abbreviated as XAU, is primarily traded against major currencies, with the US dollar pairing, XAUUSD, being the most common. Before applying technical analysis, it's essential to understand that gold prices are influenced by several fundamental factors. These include inflation rates, which often correlate with higher gold prices as investors seek protection against currency devaluation. Geopolitical tensions typically drive investors toward gold as a safe haven asset. Central bank policies, particularly interest rates and gold reserve changes, significantly impact gold prices. Finally, overall market sentiment affects gold's perceived value as either a risk-on or risk-off asset. For gold trading analysis and execution, traders use various platforms that offer specialized tools. MetaTrader 4 and 5 are among the most popular platforms, offering comprehensive technical analysis tools specifically for gold trading. Most gold traders use candlestick charts for technical analysis, which display the open, high, low, and close prices. Traders select different time frames depending on their trading style. Short-term day traders might focus on 15-minute charts, while position traders often use daily or weekly charts. To summarize, understanding gold trading basics provides the foundation needed before applying technical analysis strategies like support and resistance. Trading gold effectively requires understanding key strategies based on support and resistance levels. There are 3 core strategies for trading gold using support and resistance levels. These include bounce trading, breakout trading, and range trading. Each offers distinct advantages depending on market conditions. The first strategy is bounce trading. Here, you enter long positions when price bounces off support levels and enter short positions when price rebounds from resistance. Place stop losses just beyond these levels to manage risk. The second strategy is breakout trading. When gold price convincingly breaks through an established support or resistance level, it often indicates a continuation of that move. After confirming the breakout, enter a trade in the direction of the break. Place your stop loss below the broken level to protect against false breakouts. The third strategy is range trading. When gold is trading within a defined range, you can buy near support and sell near resistance. To improve your success rate, combine support and resistance strategies with confirmation signals from momentum indicators like RSI and MACD. RSI can confirm whether gold is oversold near support or overbought near resistance, while MACD crossovers help validate trend direction. When trading gold using these strategies, proper risk management is essential. Gold markets can be more volatile than other assets. Use wider stop losses than you might in other markets, typically 1.5 to 2% beyond support or resistance levels. Set clear profit targets at the next significant support or resistance level in the direction of your trade. And always limit your position size to 1 to 2% of your trading capital per trade to account for gold's increased volatility. To summarize these gold trading strategies, use bounce trading to enter at support and resistance rebounds. Use breakout trading when levels are convincingly broken. Use range trading when gold is moving within defined boundaries. Whatever strategy you choose, always confirm with momentum indicators and implement proper risk management techniques specific to gold's unique characteristics. Risk management is crucial when trading gold due to its high volatility. The most fundamental rule in risk management is the 1 to 2% rule. This means you should never risk more than 1 to 2% of your trading capital on a single gold trade. This approach prevents catastrophic losses during volatile market conditions and allows for a consistent trading approach over time. When trading gold, calculate your position size based on your stop loss placement relative to support and resistance levels. Support levels, shown here at $1,910, can serve as guides for stop loss placement. If you enter a long position at $1,950 with a stop loss just below support at $1,905, Your risk per ounce is $45. To calculate position size, divide your risk amount by the risk per ounce. With a maximum risk of $200 and a $45 per ounce risk, you can trade 4.44 ounces. During major economic announcements or geopolitical events, gold prices can gap through support or resistance levels. As shown here, significant news can cause gold to open at a much different price than its previous close, creating a price gap. To manage this risk, reduce your position sizes during uncertain periods. Price can gap through your stop-loss levels, potentially causing larger losses than anticipated. Consider using wider stops or hedging strategies during these periods, and always stay informed about upcoming events that could affect gold markets. Use trailing stops to protect profits as gold moves in your favor, especially when approaching the next support or resistance level. After entering a long position, set an initial stop loss below your entry point. As the price moves in your favor, raise your stop loss to lock in profits. Continue raising your trailing stop as the price advances, but never move it lower. As price approaches resistance levels, tighten your trailing stop to protect most of your profits. Trailing stops allow you to capture most of the move while automatically protecting your profits. Consider taking partial profits at resistance levels for long trades, rather than targeting the entire position at one price level. After entering a long position, identify key resistance levels where you might take profits. As gold approaches the first resistance level, consider taking partial profits, such as 50% of your position. This allows you to lock in some profit while keeping partial exposure if gold continues higher. If gold reaches the second resistance level, you might take profit on the remaining position. Remember that gold's 24-hour market means support and resistance levels can be tested during different trading sessions. Gold trades across Asian, European, and US sessions, with each market capable of testing key price levels. Support or resistance levels broken during the Asian session may be retested during European or US sessions. Always consider using 24-hour charts for your analysis, and be aware of overnight gap risk when holding positions. In gold trading, avoiding common mistakes is just as important as using effective strategies. The first critical mistake is treating support and resistance as exact price points. In reality, these are zones where price action often responds. The second common mistake is overtrading. Many traders enter positions too frequently without waiting for clear confirmations at support or resistance levels. The third common mistake is ignoring the broader market context and fundamental factors. Gold prices don't move in isolation. They're influenced by factors like USD strength and central bank policies. Now, let's explore some advanced techniques that can elevate your gold trading strategy. Multiple timeframe analysis helps identify stronger support and resistance levels. When the same level appears across daily, 4-hour, and 1-hour charts, it carries more significance. A powerful concept in technical analysis is role reversal, when former resistance becomes new support after a breakout, or vice versa. These retests often provide excellent trading opportunities. Moving averages can act as dynamic support and resistance levels. The 50, 100, and 200 EMAs are particularly important in gold trading, often serving as areas where price bounces or reverses. With consistent practice, you'll develop an intuitive sense for how gold reacts at key technical levels. This intuition, combined with disciplined trading and proper risk management, will significantly improve your gold trading results.